Good morning and welcome to Killick & Co.'s weekly podcast for Monday the 11th of August. I'm Patrick Gordon, standing in for Paul Kavanagh this week. Before we look ahead, it's probably worth reflecting on the events of last week, which proved to be, for the most part, quite a difficult week for risk assets. We had equity markets selling off, and also parts of the high-yield fixed income markets losing ground during the week. While on the other hand, we had core government bond yields benefiting from a flight to safety and demand for safe haven assets during the week. However, what we saw on Friday was a bit of a reversal of the trend from earlier in the week, when we had the S&P in fact rally towards the end of the day and erase its losses from early in the week. On a change in sentiment, particularly regarding the geopolitical situation surrounding Ukraine and Russia. What this seemed to indicate is that the underlying tone of the markets is still relatively bullish, and you have investors looking to buy into the dips in the market. In terms of the fluidity, though, there's still a lot of uncertainty in the geopolitical situation. And we are likely to see headlines driving the markets in either direction in the near term. And so we can expect some further volatility in the markets as we go forward. In terms of macro data last week, well, it was a mixed picture. In the Eurozone, there were signs that the economic recovery is struggling a little bit. We had Italy dipping back into recession. And also out of Germany, we had some indicators. The industrial production number was weaker than anticipated, and also the factory orders number was weaker than anticipated. So signs that in the Eurozone there is a bit of economic weakness coming back into the market. But in terms of the US and the UK, further signs of strengthening in the economy, is particularly in the services sector, where we've seen some good strength. ISM numbers out of the States were very strong. The new orders component, the forward-looking component, was very strong and rebounded strongly from its previous reading. And also the hiring intentions within the services industry are strong. And this has led some market participants to be slightly concerned that the Fed may need to raise rates ahead of current expectations. And this has weighed on parts of the market during the past week or so. In terms of interest rates, well, we had central bank decisions from the Bank of England, and the ECB had their decisions on monetary policy last week. We didn't see a change from either bank, and that was in line with expectations. In terms of the Bank of England, what we will be looking for is the minutes in a couple of weeks' time, where we've had mixed messages coming out from Mark Carney as to the potential timing of interest rate rises. And so we'll be looking to the minutes to see if the unanimous decisions we've seen up to now, whether we're actually going to start seeing some dissension in the ranks there of the committee members. And certainly some of the more hawkish members of the committee have suggested that if we're going to have a gradual rise in interest rates, then we may need to see interest rates start to rise sooner rather than later. In terms of the ECB, no change in policy there either. This was to be expected, and they announced a raft of policy measures back in June, and it's going to take a while for those to work into the real economy. And so even though the bias of the central bank is still towards easing, which is unsurprising given the recent weakness in the economy and also the very low inflation data. So in time we may see some more monetary policy easing in terms of either asset-backed security purchases or outright quantitative easing. Turning to the week ahead, the big day for us or on the economic data, is probably Wednesday, certainly in the UK, where we've got UK unemployment data and also the Bank of England's latest quarterly inflation report. The unemployment data, we're expected to see a slight tick back in the unemployment rate from 6.5 to 6.4%. We're not expecting to see a lot of change in the inflation report regarding the growth forecast or the inflation outlook. But we will be looking at that to see what the committee is saying, the Monetary Policy Committee and Bank of England are saying about the slack in the labour market. In terms of other economic data points, we've got the UK GDP on Friday. The initial reading of this showed 0.8% growth quarter on quarter, and that's what we expect to see again, no change in the next reading. And as far as the Eurozone goes, we've got the final reading of the Eurozone CPI. The initial estimate of that of just 0.4% was the lowest in 5 years. So we'll keep an eye on that to see if there's been any change on that. In terms of corporate news, a fairly quiet week this week. For us, the main releases is probably from Prudential. This is one of our stocks. And the research teams continue to like this stock, even though it does trade on a premium to most of the other insurers. The feeling here is that this is a justified premium given the superior growth outlook for the company, given its exposure to parts of the Asian and also the US market. We also have Glencore with a production report on Wednesday. This follows very good results from Rio Tinto last week. And that where they actually showed there's an increased focus on capital discipline and shareholder returns. Just turning to some of the charts, this is the S&P 500 really just to show how we did see the reversal late on Friday after the sell-off that we have seen during the week so far. So this bullish sentiment has followed through. We've seen the Asian markets rally overnight, and also we're seeing a positive trend to European markets this morning. In terms of the government bond yields, this is an area which has continued to benefit from the flight to safety and the safe haven. It's interesting to note that for the US and the UK Treasury markets, started the year at 3%, and the expectation was that this was going to continue. Almost every economist had forecast that we were going to see a gradual trend up in this rate from 3% upwards. But clearly we haven't seen that, and this does indicate that there is some concern out there about the sustainability of the economic recovery, but also obviously the flight to safety given the geopolitical concerns out there. In terms of the Bund, this has benefited not just from the flight to safety, but also by the expectation that the ECB is going to loosen monetary policy further. And so that is increasing the spread between the Treasury and the UK gilt and the Bund. In terms of the UK GDP picture, just a year ago, and this just shows how the forecast for 2014 real GDP has changed over the year. A year ago, the expectation was GDP in 2014 was going to grow by 1.4%, 1.6%, but we are now at 3%. So you can see how the economic data has fed through into a more bullish picture for GDP growth in the UK. Despite the growth, though, that we've seen, we haven't seen a lot of wage pressure. So inflation concerns are still fairly muted. This is a chart which just shows this. And this is an area really on the inflation report where there is going to be a lot of focus, as I mentioned previously, the degree of slack in the employment picture. And then just finally to end, it is a quiet week, as I mentioned, for corporate news. But one sector which did take a little bit of a hit last week was the pharmaceutical or the healthcare sector, where you had the likes of AstraZeneca, Shire, and also Smith & Nephew losing a bit of ground after reports that the so-called tax inversion benefits for US companies acquiring UK companies, the tax benefits which may have resulted from a US acquirer changing its tax domicile to the UK, talk that those sort of benefits may be curbed, has had an impact on the sector, where the companies in the sector had been mooted as potential takeover targets by big US firms. We do still like Smith & Nephew. given its leading position in the orthopedic and medical devices world, and it does form part of the thematic note. It's covered in more detail in the thematic note on healthier living. So if you have any questions relating to Smith & Nephew, please do refer to that note or speak to your broker.